Have you ever noticed how a single decision from the US Federal Reserve can move stock markets, shake currencies, or even cause crises in countries halfway across the world? It sounds unreal, but that's how powerful the Fed is. Let's break it down. First, it all starts with the US dollar. The dollar isn't just America's currency, it's the world's currency. About 60% of global reserves are held in dollars, and most international trade is priced in it. So when the Fed changes interest rates or adjusts its policies, the value of the dollar moves. And because so much of global finance is tied to the dollar, that one change ripples across the planet. If the Fed raises rates, the dollar gets stronger. Imports become cheaper for the US, but countries that depend on exports, like China or Germany, suddenly find their products more expensive in dollar terms. Second, the Fed controls global money flows through interest rates. When it raises rates, investors rush to move their money into the US to get better returns. That strengthens the dollar and weakens other currencies. You can probably guess what happens next. Emerging markets start to struggle. In 2018, for example, when the Fed hiked rates several times, countries like Turkey and Argentina faced currency crises as investors pulled their funds out to chase higher yields in America. Third, the Fed shapes global liquidity through something called quantitative easing, or QE. When the Fed wants to support the economy, it buys bonds and pumps money into the system. That makes borrowing cheaper and drives investors to look for higher returns around the world. During the 2008 financial crisis, QE helped stabilize the US economy, but it also sent a flood of money into global markets, boosting stock prices and property values far beyond American borders. Of course, when the Fed tightens policy and pulls liquidity back, the flow reverses. Capital leaves emerging markets, currencies fall, and growth slows. That's why every central bank pays such close attention to what the Fed does. One decision in Washington can shift global finance overnight. And finally, scale matters. The United States makes up roughly a quarter of the world's GDP. Its banks, investors, and markets are all deeply connected to the rest of the world. So when the Fed cuts rates, like it did during the COVID-19 pandemic, it doesn't just stimulate the American economy, it sends money rushing across borders, fueling stock rallies and real estate booms from New York to Singapore. So in the end, the Fed's global influence comes down to three things: the power of the dollar, the control of interest rates and liquidity, and the sheer size of the US economy. Every time the Fed acts, markets move, currencies shift, and economies everywhere react. So next time you hear about a Fed meeting, remember, it's not just an American story. It's the story of how one institution sets the rhythm for the entire global economy.